Welcome to this explainer. Look, today we're unpacking a company that is absolutely defying financial gravity, Vicor Corporation. We're going to dive into some fascinating and frankly completely contradictory metrics here. If you track the markets, you know finding a business with both explosive growth and a flawless balance sheet is kind of like spotting a unicorn. But what happens when that unicorn comes with a staggering price tag? Well, that is the exact paradox we're going to unravel today by looking under the hood at the hard data.
Okay, let's dive right into this. 580.94%. Yeah, you heard that right. That massive number is Vicor's trailing 12-month return. I mean, just let that sink in for a second. If you threw capital at this a year ago, it would have multiplied nearly 6 times over in just 12 months. In an environment where we typically cheer for a 10% annual return, a near 600% surge, that's the kind of metric that forces literally every investor to sit up and pay attention.
But of course, a number like that immediately begs a two-part question, right? How exactly did they pull off this astronomical growth? And more importantly for us looking at it today, is it too late to buy in? Like, are we witnessing a fundamental shift in the company's core value? Or are we just staring at a momentum-driven bubble stretch way past reality? To figure that out, we really need to break down the numbers step by step.
Section 1. The rocket ship returns. Unstoppable momentum.
So to figure out if this recent surge is just a weird anomaly, we've got to look back at historical performance. And let me tell you, holding Vicor is for sure not for the faint of heart. Just look at these recent numbers. We've got a massive 144.85% year-to-date return for 2026, coming right on the heels of a 126.82% return in 2025. But, and this is a huge but, check out 2022, a brutal negative 57.67% drop. It clearly shows us that while the upside is totally explosive, the downside can be just as punishing. It is a high beta roller coaster.
Now let's zoom out and see how this builds over a much longer timeline. 2,646%. That is Vicor's 10-year return, and honestly, it completely reshapes the narrative. It tells us that despite that aggressive volatility we just talked about, the long-term compounding power here is staggering. This isn't just a sudden flash in the pan. It's not some meme stock that popped yesterday. This is a company consistently generating massive wealth for a solid decade.
Section 2. The Profit Engine. Unpacking the growth.
You know, market hype can drive a stock for a bit, sure, but over a 10-year stretch, you need actual real growth. And what's really interesting here is the sheer acceleration. It's breathtaking. We're looking at the compound annual growth rate for Vicor's net income. Over 5 years, it's a highly respectable 45.76%. Over 3 years, it revs up to 66.82%. But then look at that trailing 12-month figure, an explosive, almost unbelievable 1,834.35% acceleration. The company isn't just growing, its profitability is literally going parabolic right now.
And they're pulling this off incredibly efficiently. Check out these margins. A gross profit margin of nearly 51% means they have serious pricing power and super low direct production costs. Plus, the net profit margin is sitting at a very healthy 15.01%, alongside a return on invested capital of 11.33%. What does this tell us? It proves Vicor isn't just padding top-line revenue for the sake of it. They're a highly efficient machine, effectively converting those sales into actual, hard, bottom-line profit.
Section 3. The bulletproof armor. A flawless balance sheet.
Now, growth is fantastic, but what happens when the economy inevitably hits a speed bump? Well, enter this beautiful number, 0. That represents Vicor's debt-to-equity ratio, meaning they have absolutely no long-term debt burdening their equity. It's literally a perfect metric for financial stability. In a climate where high interest rates can completely cripple over-leveraged companies, Vicor operates with the absolute peace of mind that comes from owing the banks nothing, 0.
Building on that zero debt, their liquidity ratios are just off the charts. We're talking a current ratio of 899 and a quick ratio of 759. To put that into perspective, a quick ratio of exactly 1 means you can just pay off your immediate debts. Vicor, they can pay off short-term liabilities more than 7.5 times over using just their most liquid, easily accessible assets. They are sitting on an incredibly abundant cash cushion.
Section 4. The reality check. The valuation problem.
So the crucial point is, we have a business with explosive growth and a flawless balance sheet. The catch? The price. Just look at this stark contrast.
A last close price of $268.36 sitting right next to a calculated fair value of just $127.07. And that fair value isn't just someone's guess, it's rooted in rigorous, discounted cash flow models. Right now, the market is pricing this stock at more than double what its underlying cash flows suggest it's inherently worth.
And that massive discrepancy leads us straight to this glaring negative number, a margin of safety of negative 111.19%. Now, as a savvy investor, you know your margin of safety is basically your financial shock absorber. So when it's highly negative like this, it means the stock is heavily inflated compared to its intrinsic value. You have zero shock absorber here. If the company makes literally a single misstep, the market correction could be absolutely brutal.
And traditional valuation metrics totally confirm this extreme premium. We're looking at a PE ratio of 102.82, a price-to-sales ratio approaching 30, and an enterprise value to EBITDA ratio of over 204. That means you are paying over 200 times the cash the core business actually generates. These are just astronomical figures. A PE ratio over 100 means the stock is currently priced for absolute, unwavering perfection. People are paying a massive premium today for growth they just assume is going to happen years down the road.
Section 5. Weighing the paradox, growth versus price.
So, how exactly do you weigh phenomenal financial growth against a sky-high premium? Because this is the ultimate investor paradox right here. On one hand, the fundamental strengths are totally undeniable, right? A perfect balance sheet with zero debt and hypergrowth backed by an 1,800% surge in trailing net income. But then on the other hand, you have glaring weaknesses, extreme overvaluation across basically every traditional metric, and a highly dangerous entry price with a negative 111% margin of safety.
Which leaves us with a final, provocative thought to really ponder today. Does a flawless balance sheet and incredible momentum actually justify paying over 100 times earnings? Because in the markets, a great company isn't always a great investment if the price is wrong. Vicor is undoubtedly a fundamentally stellar business right now, for sure. But whether its stock is a wise addition at these extreme altitudes, well, that's a question of your own personal risk tolerance and whether you truly believe they can execute perfectly for years to come. Thanks for joining me for this explainer, and as always, keep questioning the numbers.